Rohr here with another concise highlight early on Wednesday, June 18th, 2014. It's Fed Day, and it's currently 6:15 a.m. U.S. Central Time, and we are providing this concise highlight focused on the equities and fixed income because after the extensive review of foreign exchange yesterday, just not much has changed in that area, and we will mention what's going on a bit later. But for now, the macro data, as we know from Tuesday, was weak on everything from Chinese foreign direct investment right into U.S. housing figures. And yet today we come in with strongish data across the board. It shows how mixed things are. That's the Japanese trade balance, Australia leading indicators, Chinese MNI business indicator, and even Eurozone construction output from one of the weaker areas on the planet right now. And there's not that much out in the U.S. at all prior to the 1 o'clock p.m. FOMC rate decision and 1:30 p.m. Central U.S. time press conference with Fed Chair Yellen. Now, the other important central bank influence along the way was the highly anticipated Bank of England minutes this morning. And they were as expected in that there was much more focus on a balanced sentiment on the Monetary Policy Committee. That's from a previously more accommodative view. So that's viewed as a bit not so much hawkish as less accommodative. And that is consistent with the fact all 9 members voted to keep rates steady at the last meeting, but are now considering whether they should go up. However, from a market standpoint, that seemed to be built in. There was a lot of fear and loathing in the government bond markets yesterday on Tuesday in anticipation that maybe those minutes would even be a bit more hawkish than expected, and the bonds, as we will see, are recovering. But getting on to the short-term view of the S&P 500, what we have is a market that is reflecting something we mentioned yesterday in the form of FED-ralysis. And that's, of course, the pre-Fed announcement paralysis this market often goes through. And as we suspected at the time, that takes on a constructive tone, because there is still a sense out there, in spite of what some Fed governors have said and Bank of England Governor Carney's comments on maybe rate hikes would have to come sooner than expected, that Janet Yellen will remain accommodative in her comments today. And only once the Fed announcement and the press conference are out of the way will the equities be done reflecting that and might get back to trading off the data and might weaken off again on other troubling geopolitical global influences. And so what we had yesterday was, once again, tremendous intraday volatility, just like we had going back to Monday, when the market came in and put on, in the first couple hours, put on a quick $10 swing and then just churned steady the rest of the day. Similarly, yesterday, in the first hour, we saw the market come down from what was actually 1934-35 area overnight, $10 sell-off, snaps right back up, and then churns its way higher to get back up around 1935 and sit up against it. Now, 1935 is one of the 2 resistances we've noted, given the lead contract resistance up at 1942 to 45, and with a $7 discount in the September contract, we're looking at 1935 to 38 as resistance. And you can see how that fits in with the previous congestion from the topping action going back into the early part of last week. And on the downside, we still have very good support based on continuation levels and also the congestion itself in the September contract down into 1920 to maybe around the 18 to 17 level. And in terms of the indicators, just not much there right now, because what we have is a situation where the short-term MACDs are not really near their runaway bands. The stochastics look a bit overbought, but this market's likely to remain quietly bid into the Fed, so we're not looking for much there. And shifting over to the intermediate term view, weekly chart on the left and the daily on the right, we can see how all of the indications for the from the short-term charts are reflected here as well. Note that the 18-day average is right down toward that 1920 area. The bigger supports, in fact, are down toward the weekly runaway gap down around 1900, and the commensurate gap in the September was here around the 1897 area on down for about $5. So there's real good support if the market should take the bigger correction into 1900 area. And if you look at the Fibonacci and congestion on the daily chart, and even the start of the heavier congestion on the weekly, as you get into the upper 1800s. And resistance would be, even if it gets through 35 to 38, the gap down going back to last Wednesday was from 1943, at which point SEP would be testing the lead contract resistance levels. And that's pretty much it for the view of the S&P 500 future.